Hey everyone, and welcome back to the channel. If you're looking to sharpen your trading skills and make more informed decisions in the market, then you've come to the right place. Today, we're diving deep into one of the most popular and powerful tools in a trader's arsenal, the exponential moving average, or EMA. You've probably heard of it, but understanding its nuances can truly elevate your trading game. Before we jump in, hit that like button, subscribe to the channel if you haven't already, and ring that notification bell so you don't miss any of our future trading insights. Alright, let's get straight to it. So, what exactly is the EMA, and how does it differ from a simple moving average, or SMA? Think of a moving average as a line that smooths out price data over a specific period, helping us identify trends and reduce market noise, while an SMA gives equal weight to all prices within its calculation period. The EMA is a bit more sophisticated. It places a greater emphasis on recent prices. This means that the EMA reacts to price changes much faster than an SMA, making it a favorite for traders who want to catch trend reversals or continuations more quickly. Why is this important? Well, in fast-moving markets, getting a jump on a trend can make a huge difference in your profitability. The EMA's responsiveness can provide earlier signals, helping you to enter or exit trades with better timing. We're talking about real-time insights that adapt to the market's current pulse. Now, let's talk about the different types of EMAs you might encounter. Just like SMAs, EMAs come in various periods. The most common ones you'll see are the 9-period EMA, 20-period EMA, 50-period EMA, and the 200-period EMA. Each one serves a different purpose based on your trading style and time frame. For example, shorter period EMAs, like the 9-period or 20-period, are excellent for day traders or swing traders looking for short-term trend changes. They hug the price action very closely, giving you quick signals. If you're trading on a 15-minute or 1-hour chart, these shorter EMAs can be your best friends for identifying quick entries and exits. On the other hand, longer period EMAs, such as the 50-period or 200-period, are better suited for identifying longer-term trends. These EMAs are slower to react but provide a much clearer picture of the overall market direction. They're great for position traders or investors who are looking at daily or weekly charts and want to filter out the short-term noise. Think of them as the big picture indicators, helping you stay aligned with the dominant market movement. So, how do we actually use the EMA in our trading strategy? Let's break down some practical applications. One of the most fundamental ways is for identifying the trend. When the price is consistently staying above an EMA, it generally signals an uptrend. Conversely, when the price is consistently below an EMA, it indicates a downtrend. It's a simple yet powerful visual cue. For example, if you see the 50-period EMA sloping upwards and the price remains above it, you've got a pretty good indication that the bulls are in control. Another incredibly useful application is using EMAs as dynamic support and resistance levels. Unlike static support and resistance lines, which are fixed at certain price points, EMAs move with the market. During an uptrend, an EMA can act as a dynamic support level, where prices tend to bounce off it before continuing their upward movement. Traders often look for opportunities to buy when the price pulls back to and respects an upward sloping EMA. Similarly, in a downtrend, an EMA can act as dynamic resistance, where prices struggle to break above it and tend to fall back down. You might look to sell or short when the price retraces to a downward sloping EMA and gets rejected. This provides excellent points for entry and risk management because you have a clear level where your thesis would be invalidated if the price breaks through. Now, let's talk about one of the most popular and effective EMA strategies, the EMA crossover. This strategy involves using two different EMAs, typically a shorter period EMA and a longer period EMA. Common combinations include the 9 and 20 EMA, or the 20 and 50 EMA. The magic happens when these two lines cross. A bullish crossover occurs when the shorter period EMA crosses above the longer period EMA. This is often seen as a strong buy signal, indicating that momentum is shifting upwards and a new uptrend might be beginning or strengthening. Imagine the 9 EMA surging past the 20 EMA. It's like a green light flashing on your chart. Conversely, a bearish crossover happens when the shorter period EMA crosses below the longer period EMA. This is typically interpreted as a sell signal, suggesting that downward momentum is building and a downtrend might be starting or accelerating. Picture the 9 EMA dipping below the 20 EM, a potential red flag for sellers to enter or existing buyers to consider exiting. EMA crossovers are fantastic for trend confirmation and timing entries. However, like all indicators, they are not foolproof and can generate false signals, especially in choppy or sideways markets. This leads us to a crucial point. The EMA is best used in conjunction with other indicators and analysis methods. This brings us to the importance of combining EMAs with other tools for confirmation. Don't rely on EMAs in isolation. For instance, you could combine EMAs with volume indicators. If you see a bullish EMA crossover accompanied by high trading volume, it adds more weight to the signal, suggesting strong conviction behind the price move. Low volume on a crossover might indicate a weaker signal or a potential trap. Another great companion for EMAs is the Relative Strength Index, or RSI. The RSI helps you identify overbought or oversold conditions. If you get a bullish EMA crossover, but the RSI is showing that the asset is heavily overbought, you might want to exercise caution. It could indicate that the move is extended and due for a pullback. Conversely, a bullish crossover when the RSI is emerging from oversold territory could be a very powerful signal. You can also use chart patterns and candlestick patterns to confirm EMA signals. For example, if you see a bullish engulfing candle or a hammer candlestick forming at an EMA support level, it provides strong confirmation for a potential bounce. The more confluent signals you have pointing in the same direction, the higher the probability of a successful trade. This multi-indicator approach helps to filter out noise and improve the quality of your trading signals significantly. Now, let's talk about the key benefits and also some limitations of using EMAs. The primary benefit, as we've discussed, is their responsiveness. This makes them excellent for dynamic market conditions, giving you quicker insights than SMAs. They are also incredibly versatile, applicable across various timeframes and trading styles, from scalping to long-term investing. Plus, they are widely available on almost every charting platform, making them accessible to everyone. However, no indicator is perfect, and EMAs have their limitations. The biggest one is whipsaws, especially in choppy or range-bound markets. Because they are so responsive, EMAs can generate many false signals when the price is not clearly trending. This can lead to frustration and unprofitable trades if you're not careful. This is where the importance of combining EMAs with other indicators and overall market context comes into play. Another limitation is that EMAs are lagging indicators. While they are faster than SMAs, they still follow price action rather than predicting it. They tell you what has happened and help confirm current trends, but they don't predict future prices with certainty. Therefore, they should always be used as part of a broader analytical framework. Never treat any single indicator as a crystal ball. So, to summarize, the EMA is an incredibly valuable tool for identifying trends, spotting dynamic support and resistance, and generating entry and exit signals through crossovers. It's faster and more sensitive to recent price changes compared to the SMA, making it a favorite for many active traders. Remember to experiment with different periods, like the 9, 20, 50, or 200 EMA, to find what works best for your specific trading style and the assets you trade. And critically, always use EMAs in combination with other indicators, like volume, RSI, or chart patterns, to confirm your signals and minimize false positives. This holistic approach is key to developing a robust and reliable trading strategy. Practice, backtest, and refine your techniques, and you'll be well on your way to mastering the Ema. I hope this deep dive into the Ema indicator has been helpful and gives you a clearer understanding of how to incorporate it into your trading. If you enjoyed this video, please give it a big thumbs up, share it with your fellow traders, and leave a comment below with your favorite Ema strategy or any questions you might have. We love hearing from you, and if you haven't already, make sure to subscribe to the channel and hit that notification bell so you don't miss our next valuable trading lesson. Thanks for watching, and I'll see you in the next video. Happy trading!